Hey guys, Felipe and Stefan dropping in, and today we're here to talk to you about a tactical guide to managing the process. And Stefan has been through it all, raising over $100 million in fundraising. So Stefan, how did you approach reaching out to investors once you started fundraising?
I would say it's important to understand what is the mindset when you go into fundraise. So first of all, fundraising is a bit like dating. It's about psychology. You need to understand what are the objectives of the different people involved and how you can bring everything together. And you want to make sure that you create that competitive tension between the different investors, that FOMO, to really make sure that you get the sense of urgency. Next one is practice. You basically cannot practice too much and you cannot be too well prepared. People think it's just casual conversations with funds and then you ask them, do you want to invest? And they invest and everything is great. Here, you need to think about it. It's really a process. It's even a month-long process that you need to be mindful of when you start the journey. So on average, a fundraise can be 6 months, depending on, let's say, early versus late stage. But think about it, you have different elements. First of all, you need to get in touch with VCs, you need to have the first conversations, build up a relationship, then you engage further, there's maybe interest, eventually they may put in a term sheet, then you sign a term sheet, then there's diligence, there's closing. So you see there are a lot of elements involved. So you need to make sure when you start, you're very well prepared, that you can synchronize and coordinate everything from the beginning, especially because it's not just one fund that you're speaking with. Oftentimes, you're managing multiple funds or multiple investors in parallel. The third point, and this is a question we're always getting, is how broad should you go?
What do you mean by that?
Should I just speak to every investor on the street and try to get the capital? So should I just basically spray and pray and hope that, one fish bites? Or should I rather get targeted? And there, I've seen both. It depends really on the situation, but it's good to be a bit broader. So let's say these are the 5 funds that you want to go for. It's good to have some additional funds to give you a bit of, let's call it, buffer. Maybe also to, let's call it, practice with and warm up with. But you also don't want to just speak with every fund out there because you will lose a lot of time. And keep in mind, for the VCs, it's very rare that they give you a hard no. So you can speak with them, you think they're interested, but actually you're just wasting time. And in the end, you're speaking with a lot of people, but nothing concrete materializes. So I would say those are the key elements here.
So what happened if somebody wasn't responsive to you?
There's a couple of elements. As we said earlier, FOMO is key. So if they're not responsive, that means they're most likely not interested. So sorry for you, but that's not a good sign. What can you do about it? Number one, use the what I call I'm in town method. Let's say there's a fund that is in New York. Next time you're in New York, just drop them a message, say, hey, I'm in town, let's catch up for a coffee. This is a good way to connect without basically being pushy or asking them to get involved. And then in that conversation, you can also feel a bit more what are the reasons why they're not interested. And if you're clever, you have some interesting business updates or maybe some other funds that are interested, and you can then also drop that. So then after that meeting, they will take it away and maybe come back more active. Next point is then also how to create a FOMO to activate other funds. So the best way to accelerate a fund is to have another fund. Don't worry too much about that particular fund. Focus on other funds and how you can lock them in. And if you get another term sheet, make sure that you keep the other fund in the loop, obviously before you sign the term sheet. But this is a good way then to see if they're interested. If they are still somehow interested, they will say, oh, let's take another look and let's see what we can do. Or they will say, look, it's not interesting for us. And that means they just don't like the business for whatever reason.
So they're interested. Now what? Do you send them the pitch deck?
Yeah, so you can send them the pitch deck. It depends really on the level of interest. You can send them the pitch deck beforehand or not. But let's say if you would engage, you would send them the pitch deck. Just important, ideally don't send it directly via email. If you're smart, you use DocSend. That's a service like a mini data room that you can use. What is the benefit there? People need to sign up with their email address to see your deck, and you can see as the provider on the other side who is looking at the materials from the counterparty side, and also which pages they're most focused on. So this gives you also a good indication of if they're interested or not. So that's something that works. Plus, if you want to, you can also then add watermarks on top so they will not just share it with others. That's how we have done it, and now we have seen also many others do it. What's your perspective?
I quite like the PDF. The reason being, if I'm interested in an opportunity and I'm going to take it to a pipeline call to get buy-in from the greater team to do more work on that company, usually I would send the deck beforehand to the team so they can learn about the opportunity. What I found with DocSend is that unless they enable the download feature, we would have to go in and take screenshots of the deck to put it into our own deck to share with the broader team. So, if you are using DocSend, just keep in mind that many investors will actually ask for the PDF. It's easier for them. And before sharing these documents, would you guys ask for an NDA?
No, you don't send an NDA. So what you can do is you can get the NDA later on once you share the full data room. But for the intro deck, you would not do an NDA. Why is that? Frankly speaking, this is because VCs are seeing so many opportunities and they want to move fast, and the whole industry is built on trust also for them, for the VCs. So if there's a case now, let's say I'm the entrepreneur, I sent you now the deck and you just send it around, and it turns out that you were the one sending it around, that puts you, but not only you, the entire fund, in a bad spot. So no NDA from the intro deck, but NDA then later on once it comes to the data room.
In my view, if you were to share this document with other people, then your reputation comes crumbling. As a VC, your entire reputation is built on trust. And so it's a little bit of this notion that, say, I'm an investor and a competitor of your company. What I found a lot of the time is that entrepreneurs are hesitant to share the deck because they know I'm invested in the competitor. But, it's a little bit this notion that I wouldn't share that deck, not only because of the reasons we've already talked about, but also it's a little bit of, think of it as telling your best friend a secret from another friend, right? You lose the trust because then they know that they can't tell you a secret because you will tell somebody else. I completely agree, no NDA is necessary at the start. How would you balance talking to new investors versus existing investors?
You need to speak with both. With existing investors, the question is, can they deploy more dollars? So is this for example, late stage fund that came in early that can invest more capital into your business? Or is it an early stage fund that is tapped out? If it's an early stage fund that's tapped out, what can they help you with? They can help you with intro to other funds, but they will not deploy more capital. When it comes to existing investors that are interested, here you need to be smart. On the one hand side, you want to get them also involved. You want to ask if there's appetite, but be mindful. You also don't want to have the investors with too much of a say, and particularly one that is, let's say, has a concentrated position. So if you have an investor that might be interested in investing more, that's obviously something that's positive and shows that they believe in the business, but it's also risky for you, and you may want to add another external investor to the plate. So here you should speak with both. The advantage of new investors is that they can give you new perspectives, maybe something that currently you cannot find within the cap table. On the other side, it's also that they need to do again new work. With existing investors, they can move quickly, they can even preempt the round. What you will see is that if it's very interesting, if you have appetite from external investors, say a Code 2 comes knocking and you have a General Atlantic involved, and Code 2 is laying a term sheet, or is close to laying a term sheet, then GA might think, oh, we want to do something as well, and might preempt. And they could say, look, we can move quickly. What valuation are they offering? Look, we can do the same. Let's do it with us, and you spare the hassle of a new round. There are pros and cons, and it's a dance that you need to master carefully.
I think the framework to think about it is, if you see an investor that already has a meaningful stake in your company, we're talking 20% plus, it's unlikely for them to do more than their pro rata. That is the percentage of the company that they already own, right? So you should expect support from them up until that point. But we find that it's beneficial for most companies to seek an outside investor in each round, right? So if I go off and raise my Series B from SoftBank, maybe I go to an American fund, I go to Code 2, or I go to Tiger to lead my Series C. That way you get a new pile of cash, you get fresh perspectives for your board, and it's all about managing one, giving a pro rata ownership to your existing investors at least, and also filling the new round with new investors. Did you guys provide all the data that investors typically ask for?
Short answer is you don't provide everything. Here, again, you need to be clever because investors, they always want to get more data. They want to get more information because they need to make a decision. And to make a decision, you want to have rather more information than less. So they will have oftentimes extensive lists, but again, creating also the responses or the materials creates a lot of work. Plus, there may be certain things that you don't want to share. Depends where you are in the process. If it's more early stage or if you're very close to a term sheet. So you want to provide materials, you want to provide things, but you also want to be strategic in terms of what you're sharing when. One notion to add here that I think is quite important to mention is that you need to make sure you have the materials ready beforehand. I see that when folks are reaching out and they have investors knocking, have a data request list, or they request certain things, and then the entrepreneur says, oh, but we don't have that ready. We need to create it. How should I approach it? You want to make sure that you come prepared from the beginning. And that's why it's worthwhile to speak with folks that have been going through the process already. So you anticipate what are the questions, what are the materials, because once you do the spiel a couple of times, you already know what are the questions you would expect. And so you can prepare at the beginning of the process, when you kick off the process, and make sure you have your materials ready, and you can then basically just share them with them. And that keeps also the velocity in the process, whereby you don't have the creation times in between.
How will you know if you were going to get a term sheet?
You never know, but you can sense it. It's the way they communicate. So if somebody is close to giving you a term sheet, you may already touch on certain things like they want to ask about your prior valuation, they want to understand a bit more the runway that you have, the cash position, how much you're thinking to raise, maybe even ownership of the management currently in the business, because that helps them to triangulate a potential valuation for the new round. So basically, they're interested in doing something, but are thinking now, what are the right terms, how much they would invest in, at what valuation. So this is, let's say, one point, understanding in the conversation what they're asking for and knowing when you're close to term sheet or not. Next point, involvement of seniors. So at the early stages, oftentimes the juniors that are leading the conversations, and occasionally you might speak with a partner. Now, when you now have all of a sudden the partners being more present, or maybe even pitching to you the business, that's a good sign. So let's say if I have somebody from SoftBank or General Atlantic, all of a sudden now the partners are coming and joining the calls, and they are telling me how they're helping entrepreneurs, how they're helping portfolio companies, etc. I can sense that they're very interested and they want to schmooze to win the business. And then the third point would be office visits. If it's just calls, it's great. Nowadays we're in a digital world, so people also do term sheets. So think of the Tigers, the Cotus, they do everything digitally. They might not have boots on the ground. However, if you're meeting somebody in person, and especially if they make an effort to visit you in person, that's something we'll see where they say, oh, we would love to organize a visit where we can meet in person and discuss a bit more. That's something that's already quite positive. That means they have definitely interest and they are basically in a later stage and they want to do something. Again, it does not mean that you get a term sheet, but it shows there's a positive interest.
So you mentioned valuation, that if you're already talking terms, then that's a positive sign. At what point is it good to bring up valuation into discussion?
So as an entrepreneur, you basically don't touch on valuation. You want to make sure that there's no anchoring. The investors, they are laying the valuation and you are not commenting much ex ante. That's at least from my experience. They might ask on the previous valuation. So again, they can triangulate. So let's say your prior valuation was 100 million and your business has been growing nicely over, let's say this was a period of 12 months. So over the last 12 months, we're in a good market. So it should be an up round. It should be a higher valuation. Depends then also how much you're raising. So let's say you're raising 10 million. So then the investors, they can calculate because they know also what is a common dilution. So then they can do the math to see also what valuation makes sense. And obviously they will triangulate with competitors or peers, either in your market or in a different market. So this is something you may discuss, or probably you will discuss with investors to guide them to what are the right peers to look at. You tell them basically how they should think about your business model. What are some peers maybe in other markets where they're trading? Make sure you do the homework beforehand, that you also know what are the peers that are trading at good multiples and where you want to get benchmarked against. But from my experience, you would not directly discuss what the valuation is and rather see what the fund comes back with.
What if investors ask? From my view, if an investor asks, the entrepreneur should be ready to either point to a reference or to point to a number. What's your view on that?
Look, there is no black and white. It really depends on the conversation that you're having with the VCs and how the relationship has been, how close they are, etc. Again, I would say the kind of the going in case is you typically don't mention it proactively, but if you have a good relationship, you may also want to mention it. Why can it be useful to maybe discuss valuation is to keep in mind VCs, they want to look intelligent. So, and to submit a term sheet, typically they will need to go through the investment committee. And so if you have no clear competitors or no clear comparables in your market or in other markets, the VC might not have the guidance how to think about valuation here, aside purely from dilution in your last valuation. And so here, the IC might go to the investment committee and let's say, stick with the example that we had before and say the company is worth now 150 million. It was 100 million and now it's basically 150 million. And then the point is they are discussing that in the investment committee and they submit a term sheet with a pre-money valuation of 150. Let's say they invest 10 million, so 160 post. Let's say now you were thinking your business should be valued north of 200 or even north of 300 for whatever reason. You can obviously then discuss that once you receive the term sheet. And again, first get the term sheet because it's already good to have a term sheet and then take it from there. But now it will be unlikely that the VC comes back 1 week later and say, oh, actually we thought about it again. You mentioned those points. We will give you a valuation of 300. This is the only thing you need to keep in mind. But again, I would argue that you typically don't discuss the valuation, but this is rather something for the fund to be proactive, because again, this can give you also potentially interesting upside if you leave it a bit more blank.
Did you ever encounter just a complete mismatch in expectations between you and investors?
Let's say I can speak from my experience, but I've seen also a lot of companies and other entrepreneurs that can happen oftentimes. And I think this is because of ego ultimately, because if you're an entrepreneur, you want to have a high valuation, because in the end, it's not just the business. It also speaks about yourself, your self-worth. So you want to have a high valuation. You think you're King Kong, especially if the business is going well. You think that you deserve a high valuation. But again, maybe the market is not there yet, because also as a company, as a founder, you may see certain things that others don't see. When you're closer to the data, you have more conviction in the business. That's why you're doing it. So again, there can be big mismatches.
So now you got the term sheet. What do you do now? Do you shop around? Do you negotiate it a lot?
Couple of elements here. Let's go step by step. First of all, shop around means you basically approach other VCs, other investors, see if they're interested. That's something that's definitely recommendable, that you also speak with others, right? This is a very important decision for you, for your life, for your company, and it's a long-term decision that you cannot change. It's not a two-way door, it's a one-way door.
Right.
And so here, you want to make sure it's the right partner. It's like a marriage. You want to make sure that you see what's out there, not just the first person that you meet you may want to marry. It's good to have some comparison, but on the other side, you also don't want to just speak to everybody out there and see if they're interested, right? So you need to be also clever, or it can also damage the reputation. You want to approach others, you want to see if there's other interest, because it's an important decision, and potentially the fund that submitted the term sheet might not even be your first choice. So maybe this is more to leverage to get your preferred choice. But what's important to do that is that you already have prepared the other ones, because you cannot now come in cold to other investors, say, hey guys, I received the term sheet. Are you guys interested? Because you need to understand that there's a process behind it. It's not just Felipe saying, I want to invest, and they do it. These are oftentimes institutions where there's an investment committee, where there's certain minimum work that they need to do, and hence there's also a certain time period that they need. So what you want to do, and that's why you need to manage the entire process, you want to organize everything so that they're already warmed up, and you can rather use a term sheet to accelerate things. They are bringing now on their side, let's say the new investor that hasn't laid a term sheet yet, they haven't been to investment committee, or they might have it next week, telling them that you received a term sheet that is expiring, where you need to make a decision, can help to increase the velocity. So they might then say, let's go earlier to the investment committee, or let's see if we're interested, how we can get involved in what we can do. Next point is when it comes to negotiation, how do you approach that? It's very rare that you don't negotiate at all. And if you don't negotiate at all, it also tells the VC something. It tells them basically you have no other option and you're desperate.
Right.
And then it's dangerous because they can then squeeze you in the diligence, or they have then some leverage. They know that, and that can have certain negative effects when it comes to closing the deal. You always want to push back when the term sheets come, but you want to make sure that you do it also in a clever way. And that's important to have also legal support. Ideally, you already know certain things by listening to the course, that you understand what are the pitfalls, but it's critical to have also legal support that can guide you, because once you have the term sheet, it's basically a done deal, and you don't want to open up boxes afterwards, say, hey, but I was actually thinking I should deserve a higher valuation or this and that. So when it comes to negotiation, make sure that you leave everything clear. Once the term sheet comes, this is your time when you have leverage. In the end, it's all about FOMO, about leverage, about psychology. When you get the term sheet, the leverage is in your court. They have said that they are interested, and now it's for you to manage that. And so when it comes to getting back to them, expect typically a week. You can take a couple of days to get back to them. Make sure to keep them involved. It's fine. Don't now be absent for a month and get back to them. But I would say somewhere between a couple of days to a week, to say, hey guys, thanks for the term sheet, really appreciate it. We want to take that away. Also liaise internally with our investors. Definitely from our side, we're very excited from the management side, but we want to make sure that this is the best deal on the table, especially because we have other investors that are interested. And then you leave it there, and then you will get back to them with a markup to the term sheet.
This brings us to the end of the lesson. Thank you for watching, and we'll see you in the next video.